G'day there. Welcome to Lunch Money, your online and social media home for special situations, workouts and capital raising professionals. My name's Nick Samios. I'm the Director and Fund Manager here at Hermes Capital. And today we're talking about credit management. And we've got a special guest who I'll introduce in just a moment. I like to tell this joke to credit managers. They appreciate it. On the first day, God created salespeople. And on the second day, he created credit managers to clean up the mess. So with no further ado, let me introduce our special guest today, Nick Pilavidis, the CEO of the AICM. How are you going, Nick?
I'm great, Nick. Yourself?
Not too bad, not too bad. I did tell that joke once when I was giving a presentation to the AICM about 15 or 20 years ago, and the whole room thought it was hilarious. So
it's very much what I think as well. As soon as there were transactions, there was a credit manager that would have to come in and, as you say, clean up the mess and make sure that people get paid for their hard-won sales. Yeah.
Exactly. Tell me, it's kind of interesting. I guess the credit managers world is kind of interesting because when COVID came along, everybody panicked. We did a fine tooth comb review of every one of our files and scenario because it was going to be a disaster and no one was going to pay. And I'm sure that all of your membership would have been doing the same thing. They would have had their CEO and directors. All of a sudden, the credit manager would have been the most popular person in the room, and mapping it out. And then the government flooded the place with money, and credit managers' lives were pretty easy for 2 years. Would that be about right?
Yeah, I agree with that summary. I think that initial wave and then the cash started to flow through, and definitely our members have had benefit of that, the cash flowing through, and also the supply chain and demand issues have really meant that customers wanted to pay their accounts down to ensure supply. So their results have been great, but I think a lot of members are reporting that they feel like they've been jumping from one fire to the other, or potential fire. As you say, the outset of COVID was a huge fire or potential fire for credit professionals. That didn't eventuate, but then we're always talking about the cliff or tsunami of insolvencies, which hasn't eventuated, and every day and week there's another risk for us to be responding to, and we're only just now starting to see the signs of that come through.
Yeah, it's interesting. I mean, we're now beginning to see the signs come through. So I guess credit managers will start getting a knock on their door again from the higher ups because we are seeing building industry collapses. I guess you've got membership who would be supplying the construction industry, perhaps in the construction industry themselves, subbies, all sorts of things. I think that the reason your perspective is so interesting is that in professional circles, accountants, lawyers, and financiers, we're in the real world, but we're not kind of in the real world the way your credit managers are, because they really are, where the rubber hits the road. So look, we've got you on. Well, firstly, let me say that if anyone's watching live, you can ask questions. If you're watching on LinkedIn or on YouTube or Facebook, you can ask a question and it'll pop up and we will have a go at answering your question. And the best questions will get one of these, which is a special edition collector's item lunch money mug. At the moment, actually, Nick might be interested to know that it's very hot in my office. And instead of coffee, I've made myself a Greek frappe. There's some ice in there. And it's delicious. It is delicious. You normally get a glass, but we've got the mug.
Just the H2O for me.
No worries. Now listen, what we'll start off with just one of the reasons that we're kind of here is that you guys have recently issued your risk report. The AICM does this every year. It is quite a fascinating. Quite a fascinating document. I've printed it off here, and it's a beauty. I mean, a lot of work goes into this thing. I mean, it's 82 pages long, And I can assure you there is some really good meaty stuff in here, which we're going to get to. Graphs aside, some of the articles, some of the contributions I found really interesting, and I'd like to talk to you about as we go on. I mean, how much preparation goes into that thing? I mean, what's the behind the scenes?
Yeah, quite a lot. We're very fortunate that we've got a lot of great contributors that provide their content for us, the articles and things. But what we do is an extensive survey of our members, which I'll hopefully share with you today, some of what they've seen, and also summarising the insolvency stats and various data that we have out there all into one place. So we've hopefully got all the information credit and risk professionals need to get a feel of where we've been over the last 12 months and a bit of an outlook as to where we might be heading.
Okay, well, look, let's dive straight into some of the data. I mean, there's a lot of data in there, so let's dive into some of it. Now, I'll just make sure that I've got. Is that the first slide? I think it.
I think so. Yep.
It is.
Definitely.
Beauty. Okay, so insolvencies, it is too. It's slide 1. So insolvencies and interest rates. Talk us through this one.
Yeah, this is a really interesting one that I picked up from John Winter at Areta, who's been tracking this for a while. And historically, corporate insolvencies have tracked quite closely with that trend line of interest rates. And you can see there that as interest rates were coming down, insolvencies followed that trend. And now as interest rates have been rising very rapidly, insolvencies have been increasing as well. But I think, to me, what that shows is there's a significant lag there. While there's a quick drop-off in insolvencies is dropping, the insolvencies haven't been rising as fast as interest rates have been. So while we're getting back to pre-COVID sort of levels, I think there's a missing number of insolvencies if we look at that historical data.
Yeah, it is very interesting that as you say, interest rates have gone up. At the same time, inflation's gone up. I mean, it's very hard to try and extrapolate from this information because it's all upside down, isn't it? Let's see what our next slide is: insolvency by industry.
Yeah, this is one
usual suspects.
Yeah, that's right. Something we track quite closely is the different industries, and this is coming from ASIC's data, and they track well over a dozen industries, but these are the top 6, and not a surprise there. Construction's back to number 1, but there has been that change with other industries dropping back. They were 2019, they were the highest level of insolvencies, and they've dropped down to 4th, and now we're seeing construction, accommodation, and food services, which are traditionally the industries most represented in the insolvency numbers.
Yeah, I just thought I've just got some newspaper headlines here from recently. You know, we had insolvency bosses ready for a reckoning in construction, and that was I think that's the end of January. That article, yeah, January 30, and then recently. Porter Davis customers left uninsured as liquidated digs through the rubble. I think that was last Friday. There's two large construction firms went under in the one afternoon. What do we got here? Construction sector leads company collapses in Queensland as insolvencies surge in March. So every time one of these things, every time one of these companies goes under, we see it on the news, someone SMSs us, and then you're rushing to the ledger to see if you've got any exposure.
Exactly.
So what typically, how do your membership monitor? I guess they're subscribing to insolvency monitoring services, or what are they generally doing?
Yeah, that's right. But a great way is to subscribe to the monitoring services. Equifax, Ilion, Creditor Watch are all great services that can help you identify when there's a change to your customer. That might be a change of director or some sort of structural change, or their payment times are different to you than they are to other suppliers, can be a great sign. But I think the best way to know how a customer is tracking is from your credit team and your broader team who are interacting with them, because construction, yeah, it's high risk, but it's one of the biggest industries as well. That it's kind of relatively proportional, and not all businesses within that construction sector are high risk. There's lots of great players that have made the right decisions through that risky period that we've all seen and reported on. So really understanding each individual customer, from your experiences trading with them, from going out to the sites and seeing what's actually happening there, through just general interaction that you get on the phone call, following up payments.
Now, I mean, just on the subject of monitoring, yeah, I'm sure you get them too. I get this email here from my friend Jamison Loutet, and what I'm interested to see, it's just an email that comes every day, but what I'm interested in is the numbers are building up. You know, restructuring relief's an interesting one. You don't normally see too many of those. But the thing is, from our point of view, what we don't like to see is a lot of liquidations. You know, the list always seems to be full of liquidations. Now, today there's a few voluntary administrations. Voluntary administrations are a little bit of a leading indicator for us, because, you know, we finance, you know, distress and restructuring. And so when we see voluntary administrations, we think, right, okay, that's the sort of stuff we can get our teeth into. When we see liquidations, unfortunately, that's a sad and sorry end. Listen, let's get back to some of these graphs. So insolvency by industry. Now this is really interesting. Percent debtor versus creditor driven. So just tell us about this.
Yeah, I think that talks to what we're saying there. As you say, a lot of the organisations are going straight to liquidation. And also that lag factor that we spoke about with the RBA cash rate. So this is something that I just had a bit of a look in this year to see what that effect of the ATO and other major creditors. We hear they're not enforcing as much, and see those in those, or don't see them as much in those lists. And that really shows the difference there. It's a bit small on my screen, but I'm pretty sure it's the dark blue line is the creditor-driven insolvencies, where it's a wind-up procedure. And you can see that in the past tracked very closely, but as we entered into COVID and even prior to that, we started to see a bit of a diversion from that, where the creditor-driven insolvencies are dropping off. And obviously, since the Royal Commission, there's been a big change in collection activity, and during COVID, a lot of creditors haven't needed to. As I said, ledgers are really good, but also the ATO have definitely stopped and only just starting to pick up their activity. So I think it's interesting that we've got an increase in insolvency, because it's not because of the direct actions of creditors to wind up the businesses. Maybe it's the starting of pressure from the ATO that's driving it, that the directors are then initiating the insolvency action. But yeah, the high level of insolvencies indicates there's they're waiting to really get pushed, and there really isn't a lot of chance of recovery by the time they get there. So a big concern that companies are waiting longer than they should before taking the action to either restructure or deal with what can't be recovered.
Yeah, well, interesting. One of my questions for you a little bit later on is about the debtors using the courts, but we'll come to that in a minute. We'll just get through these slides first. But I mean, well, let's see. Where are we next? So small business restructuring. Yeah. Now this you're referring here specifically to the small business restructuring, the new thing that was brought in for COVID.
That's right. Yeah, that's one of the things that's changed dramatically. We've tracked that year on year, and in prior years the line didn't get off the bottom, and we've seen that somewhat higher levels over the last 12, 18 months. Quite a bit of fluctuation there. Obviously a bit of a drop around Christmas and financial years, and I couldn't see why there was a variation in October. So that's when our national conference is. So
well, I think that all the restructuring people, they're all at your conference.
Exactly.
That's a big impact. Yeah, you'll have to.
But they are, I think, seriously, they are small numbers, so the variation does move quite a lot, and we've seen that in recent months that you get 50% drops. But yeah, that's a big thing that people are getting across now, that we're seeing a lot more of those activities, those restructurings. A lot of members are seeing them start to affect their customers. But interestingly, they're seeing they've generally been paid up to date immediately prior to the restructuring or on commencement, whereas the ATO is the major creditor left there.
So your members, again, representing the largely unsecured trade creditors, trade suppliers. I mean, how do they feel about the SBR, the small business restructuring? Are they generally supportive? Do they think it's a good regime? What's the general feedback?
Probably a mixed feedback there, that they like the idea of businesses engaging early in the process, and to engage in a restructuring, you need to have your entitlements up to date, your lodgements up to date. So there is a positive aspect to that it rewards businesses for engaging early. At the end of the day, it's a business that's technically insolvent, so it raises alarm bells. And the big issue for unsecured trade creditors is they're asked to continue trade during that restructuring period on credit terms, but because of the high risk, they're really not in the position to extend credit. So luckily, we haven't seen that impact many businesses. They have had the cash flow to trade through that period and sustain those supplies. But yeah, that's the bit of a summary. And
I appreciate it would only be anecdotal, but do you think that because obviously you talk to a lot of people, you've got your gatherings and I mean, is there feedback that the outcomes are better? Do you know, or is it too early to tell?
As I said, most of our members have been paid in full prior to the restructuring, so I think the people involved understand that getting access to trade credit during that period is going to be very hard. So that's the best way to do it, to pay up to date. Then you might get some, but generally there's been reluctance to continue providing that. So I guess that is a better outcome, and hopefully it is. And I believe the statistics show that most of the businesses are continuing to trade after going through that process. So that's what everyone wants, isn't it? That those businesses engage, restructure, and people continue to be employed and be productive. So
absolutely. Okay, absolutely. All right, that sounds relatively positive. Personal insolvencies and the RBA cash rate.
So again, a more stark change there, that we hear daily about the pressures on individuals because of the cash rate and interest rate increases. Everyone's feeling it, from the price of tomatoes to everything, but it's not yet coming through in the personal insolvency numbers. Obviously, there's a greater change in collection strategies and processes there, but also maybe there is that cash buffers that most individuals still have, that it's yet to drive them into insolvency to cause that bankruptcy of individuals. So that's a positive thing, and hopefully that continues. But the CEO of AFSA, who monitors personal insolvency, is predicting back to 2019 levels over the next 12 to 18 months.
Okay, Mark Robinson from De Vries Taya asks a question on the line here. The insolvency trends remain relatively low, notwithstanding increasing financial distress. Do you think creditors have declining confidence in formal insolvency processes? What do you think?
There's a few things there. I guess my first reaction is they've never had a lot of great confidence in the insolvency process to recover the funds, and that might be a misconception that you expect a big dividend out of insolvency. It is an insolvent business, so you're unlikely to get full return. But those dividends have historically been very low, less than 5 cents in the dollar for the majority of insolvencies. So that hasn't changed, and hopefully with some of the work we're doing on the reviews at the moment, we might find some efficiencies for the insolvency professionals that reduce those unnecessary costs and burdens that could increase that. But going to confidence, I guess it's the complexity of the corporate insolvency process that really impacts their confidence in the process.
Well, look, this could be a good time. Thank you very much, Mark Robinson. Thank you very much for your question. Good to see a live question. I'm not sure if you've already got one of these gorgeous mugs, Mark, but in any case, maybe there'll be one there for your spouse or kids. So thank you for your question. Now, Nick, I just wonder, we might segue into one of my questions I was going to ask you, because when we talk about the formal process, obviously there can be an informal process, and often your membership will be asked to accept payment arrangements, for example, and payment arrangements raise the spectre of unfair preferences. Now, it's interesting. I had a client just this week they actually went into liquidation because they had a supplier that took them to court, and the supplier didn't accept a payment arrangement. And I speculated as to why that might be, and it may well be that they just don't want to be caught in this unfair preference situation. The unfair preference being where if you accept payment of someone who you know is insolvent, then any payments that you receive can be clawed back by a liquidator if they were received within 6 months of the event of liquidation. So if I owe Nick money, Nick knows that I've got a solvency issue, I pay him $100, and then I go into liquidation a month later. Well, an insolvency liquidator can come along and claw that money back. Now, is that how? This must be a real pain in the neck. It must be the bane of the existence for your membership. And is this what you talked to the parliamentary inquiry about, or am I getting mixed up?
No, definitely, yeah. No, that's something that we've been advocating strongly for quite a number of years to address the unfair preference regime, make that fairer. It's lots of issues there on our members, and definitely impacts them. And I think that example you had there is exactly why it's an issue for all businesses, because credit professionals are concerned that accepting these repayment arrangements and agreements will expose them to preference claims. All they're doing is trying to help their customer, provide time to pay, work with them at the point where they really need that help, where there might be potential insolvency. So they're exposing themselves to risk by continuing to trade and accept those arrangements. And then to have 6 months down the track, the company goes into insolvency, they have a loss, there's some arrears that haven't been paid, and then they're open to the risk of a preference claim being clawed back by the liquidator. The thing is, a lot of those preference claims don't get clawed back until 3 years later, because there's a 3-year period to pursue those as well. So then you're in another disadvantage, because your credit managers have changed and you're trying to work out what happened 3 years ago and trying to defend that claim for doing what you should be doing, chasing up overdue payments.
Yeah, been there, done that. Particularly during COVID, a lot of these insolvency guys were scratching around looking for things to do, and dragging out, old boxes from the archive, and suddenly remembering, oh, hang on, here's one here, a preference claim from 4 years ago. So just reflecting on my case, I guess the creditor would be sitting there going, well, they go into liquidation, we haven't recovered the money, that's the end of that. We might get 10 cents on the dollar or whatever it might be. Or we take payment and then we've got to hand it all back anyway. And then we're incurring the legal costs and the management time and the bandwidth. I mean, what's the mental process there?
My first word of advice is always take the payment. It's better cash in the hand and worry about it later. So it's very rare that you don't accept a payment. But because of that preference claim risk, credit professionals will look to mitigate that risk when there's that situation happening. So it might be asking for additional security, payments through other organisations, anything they can do to mitigate that risk, which at the end of the day just creates another barrier to the business that just needs a bit of time to pay and a bit of support and is trying to engage with the credit provider to do the right thing. So it's a barrier to efficient trade and supporting those businesses when they need it.
And do you now what do you advocate for? Are you advocating for an abolition of preference payments, or just to maybe reducing the period? How do you think it would work better?
Definitely, that's our headline request, is to abolish unfair preference claims against unrelated creditors. So definitely, if it's a related entity, there should be a much stricter regime and an efficient way to claw those payments back, because that's just defeating creditors and all those sorts of things. But yeah, we definitely advocate for the abolishment of preference claims against unsecured creditors, where there isn't actual knowledge. If they don't actually know the business is insolvent, then they shouldn't be at a risk. The current regime says a suspicion of insolvency, and not an unlikely joke is credit managers suspect that from day one, that they suspect insolvency from day one. It's their job.
I guess if you're accepting a payment plan, I guess there's an implication there. It's interesting. I mean, I guess our insolvency practitioner friends, obviously the preference claims are a bit of a honeypot for them. On the other hand, if you're a credit manager and you got nothing and someone else did get, a preference payment, you might be feeling a bit jealous. So it can cut both ways. Now, listen, we've got Grant Morris, who I know is very active in your organisation. Lots to talk about here. Did they really receive an advantage over other creditors? Are they being penalised for good collection and risk management processes? Suspicion of insolvency or deemed or actual insolvency? The list goes on. So, any reflections?
I think that's exactly what we're saying, that trying to support a customer, following normal collection activities. They're not using undue influence. They might use the court system to encourage payments. That's really not an unfair advantage over another business that hasn't done anything. And that's the intention of the legislation, is that if one entity's been paid in advance of someone else, then it goes back into the pot and distributed against all the creditors. But really that isn't fair to the credit provider that's done the hard work to engage with their customer, support them, and to benefit the credit provider that hasn't.
Okay, well, thank you very much, Grant, for your question. Thank you for that. Okay, let's move right along then to our next chart. Okay, tell us about this one. Tax total debt, 66 billion. That's the ATO.
That's right, the ATO total debt. So that's continuing to grow year on year, and something we track very closely. I try to have a look at it each year and try and bring it into comparison of some things we might reflect on. And in the past, I've compared it to GDP, and I think it ranks in the top 100 countries of GDP, the amount of debt that's outstanding. This year, I compared it to submarines, talking about the nuclear subs we're purchasing. So that amount of debt could purchase one submarine out of the 8 that are being acquired.
Right.
Which sounds a bit trivial, but that's 2,500 jobs that the government's saying each submarine contributes jobs, and there's a lot of jobs created through that. So that's one reason why it's significant, but also it's growing year on year. It's grown by double digits. I think it was 13% in that financial year.
Well, and the collectible debt is supposedly 44.8 billion. You've got that from the ATO's annual report, or have you got more up to date?
Correct. No, that's from the last annual report in June last year.
Now there is a moral hazard here with the ATO. On one hand, they're supporting small business by not chasing them too hard. On one hand. On the other hand, but there's a couple of counter arguments. Number one, from me, because they're my biggest competitor. We provide cash flow, and the ATO does it. You don't even have to apply. You just stop paying. In fact, a lot of accountants have been advising their clients over the last year not to pay tax. It's quite remarkable. I've come across that a number of times. But there is a moral hazard in that. On one hand, if you and I are competing with each other, and I'm not paying my tax, I can afford to undercut you, because I'm taking it right. So that's on one hand. Exactly. On the other hand, I know from a trade supplier, trade creditor's point of view, they're concerned that, well, the ATO knew about this, because the ATO obviously has, in some respects, a lot better information than some suppliers do. And why have the ATO allowed them to trade? And us, the poor old trade suppliers, have been continuing to supply in good faith. When the ATO maybe should have alerted us. So I know the ATO is now has the power to report to the credit agencies. I mean, what are your thoughts there?
Yeah, definitely. That's exactly why we monitor that, because it still is a hidden risk for credit providers, that they're trading along, they're getting their reports from their bureaus that we spoke about earlier. They're doing the best to support the customer. Generally, they only find about that ATO debt when it goes into insolvency, and there's a year or two of outstanding ATO debt, which, had they known about that, they could have made more efficient decisions and traded with the customer to mitigate their exposure. The measure that's brought out to disclose it is good. It's a big step forward. We do have some coming through. I think Grant, who was asking the question before, is one of the few members that have seen one of the defaults on a credit report.
Right.
But the issue there is once that business is disclosed, if they enter a repayment arrangement, that disclosure comes off the credit report like it was never there. So one day they've got a pile of debt, the next day they pay $20 on arrangement, and it's now again hidden from credit providers.
Well, it is pretty soft. I mean, I think the thing is, if you just pick up the phone to them, I think they won't report you. But look, I'm just interested again in your wonderful report here. There's a number of you do talk a lot about emerging trends and some stuff that we won't talk about. Like there's a really interesting section on buy now, pay later, and there was another really interesting article about crypto. And data security and all that stuff. We won't go into those, but if you're interested, then get hold of that report because it's really interesting stuff. But one of the sort of new technology things I did want to ask you about is AR automation, and I know, for example, that the ATO uses a lot of automation. Do you have any? Are any of your membership ATO? Do you have any?
Not directly, no. We do work with them closely, so yeah.
But they're not AICM members as such.
Not yet. There's a call out.
Not yet. Yeah, absolutely. Yeah. So what sort of trends are you seeing in AR automation that and how are credit managers embracing change like that?
Yeah, it's definitely moving along very quickly. And COVID was a big enabler of that. Suddenly the cash flow was front and center. These projects have been on the back burners for a while, suddenly got escalated and implemented very quickly. It's really a no-brainer that every business has only got a certain number of resources to do what they need to do, and being able to prioritize your workload and eliminate inefficient processes like sending out invoices or just sorting out who to contact first and reminder letters and those sorts of things can be really automated, and they can help you prioritize the customers that can pay but aren't paying, rather than calling every customer on your list.
Yeah, I guess because, I mean, obviously one of the things that the AICM does is obviously it maintains professional standards in your industry and it professionalizes the industry. And I know some of the graphs will come up to again, very interesting, in making sure that people are skilled and all the rest of it. But I guess and I know the AICM's been going for a long time. I mean, I was a member 20 years ago. But I guess as your members become more and more professional, then there is stuff that, I call it the donkey work, that you can automate. So that they're able to use their sort of more cerebral skills, doing other stuff. So I guess there's an element of that to it. Listen, let's move along. In fact, so collections performance. Now this is interesting. CCEs versus non-CCEs. So CCEs being certified credit executives as certified by the AICM versus non-certified. So just talk us a little bit through this.
Yeah, so we've surveyed our members, and this is one of the insights that was provided, that in 2022, generally most credit professionals saw their performance hold up or improve. Relatively few, I think it's about 5% when we aggregate the numbers, saw deterioration. The number to improve has dropped on the prior year, which is not surprising. The last couple of years have seen record performances for collections across the industry. So I think the prior year was 65% of members improved collections performance. This year's around 35% when you aggregate it. So still looking very positive as we entered 2022. But what we did here is look at the performance of our members, who obviously still get great results, compared to the certified credit executives, who are our most experienced and senior members. And you can see there that the marked difference, that they have greater improvements and less deterioration through that experience and knowledge. And I guess that really shows that by investing in your accounts receivable, your collections, your credit team, that returns results, whether it's in automation, as you say, or in hiring the experienced professionals, or educating your current staff to come up to speed. That
directly results in improved performance.
Yeah, it is interesting. I mean, improved performance, for example, there's 33% difference between non-CCEs and CCEs. Maybe the ATO should get some of their people to become certified credit executives, and they might bring in some of that money and pay for a sub.
There we go.
Factors contributing to improvement. Just quickly through this one.
Yeah, I guess the interesting thing here is high demand driving improvement, and that's been quite apparent in quite a number of industries, and something that we really haven't seen to that degree in the past. So I guess that's probably not a huge surprise, but shows how customers have been wanting to make sure they're well ahead of their payment terms and up to date, so that if they get that next job and they need another widget, they can get that as soon as it comes in, rather than having an overdue account slow them up.
That's really interesting, because everybody's aware of supply chain issues, and people, you hear about it all the time. And I guess what you're saying is, because there's almost a competition in some industries. There's a competition for goods. You hear that people can't get hold of timber, or can't get hold of one thing or the other. And so what you're suggesting there is that they when they need the timber, they want it, and they don't want the fact that they're a little bit of a little bit slower payer than the next guy. That's going to mean that they go down the list. That's what you're saying there, yeah?
Yeah, that's right. Most suppliers will have a credit limit that they're comfortable supplying to. So also the businesses have got more attuned to what their credit limit is, and making sure they've got that buffer there to be able to get that next supply.
Yeah. Okay, then strategies to improve results and improvements to credit processes, all things I'm sure they've learned in the process of becoming certified. Factors contributing to deterioration. The big one there is workforce shortages and inflation. So just step us through that.
Yeah, I guess there's very few that have seen deterioration, but where the pressure's been felt is in that workforce, whether it's externally with their customers or internally with their credit team. Having the access to the experienced staff to be able to manage that is probably those areas that have really impacted results. So again, seeing those human factors coming through quite strongly.
Okay, and insolvency levels in 2023, we've kind of touched, we have touched on that. I mean, obviously we've spoken about that. What's interesting is that I speak to a lot of insolvency people, and obviously there's people who get the big jobs, the Scott's Transport of this world, and obviously those guys are busy. But the smaller firms are still pretty quiet, so there's still a lot more of that to come. Collections performance again. So just this is a little bit sort of a similar theme to that earlier slide that we had. And factors impacting credit risk. Just talk us through this one. So we've got interest rates, inflation.
So this one, all those factors there are quite common that most people would be across. Really, the interesting thing for us in this report, in this survey, was the variation. In past surveys, they've all been about the same, but inflation and those cost side issues really standing out in this year's survey.
And a bit of geopolitics coming into it as well. Australia's relationship with China and the war in the Ukraine. So I guess depending on what sector you're in, but those things are impacting.
Yeah, I think that's just general uncertainty that adds to everything. That when things are uncertain, and I think that's what we're seeing at the moment, that some payments and things are slowing down, but it's probably more because people are worried about what's coming rather than actually the impacts to themselves at the moment.
Okay, listen, we've run through all your slides, but I did have some extra questions. As I said, I read through the report, and there were some fascinating articles. One of them was discussing the use of the courts by debtors to delay payment, and I was interested in that because I've seen that. I mean, we saw one matter here at the end of last year where there was a wind-up action by one creditor, as you know, with the wind-up actions, you can have substituting creditors and joining creditors and all that sort of thing. And we were watching this. Court hearing on Zoom or whatever it is. You know, the courts allow you to tune in, and there was 6 or 7 other creditors. It reminded me of the Brady Bunch. You know, you may not be old enough to remember the Brady Bunch, but all the faces on the TV,
on the Zoom screen,
on the Zoom, and what was really incredible was how this became regular viewing for us, because they kept getting the judge or the magistrate just kept giving them extensions, and I think there was 4 or 5 extensions. So is this is obviously something concerning your membership, the use of the courts?
Yeah, it is a perennial issue that when you've got a customer that maybe has the capacity to pay but doesn't want to, and are experienced with the process, that they can use that to drag out payment times. They can slow things down and extend it. It's always very tricky because those processes are in place to ensure people have due process and the ability to have a proper defence. But the frustration for credit professionals is when it's clearly used to drag things out, to increase costs, wear down a credit provider to accept compromise on a valid exposure.
And okay, so like I say, it's quite fascinating to see different aspects. You know, the magistrates seem to err on the side of giving extension, and then you'll sometimes see some creditors saying, "Listen, this has gone on too long," and all the rest of it. What's the relationship between the credit managers and, say, the insolvency profession? What are they? You know, are they on good terms, or are the credit managers wary? What's the general feeling?
Yeah, it's always an interesting relationship, and I think it's definitely improved over the last few years. We do work closely with the RETA and a lot of great insolvency professionals presenting at our risk seminars that we're doing at the moment. There is definitely a willingness to work closely with them, and things like the preference claims are probably one thing that really create that distance with insolvency professional and credit providers, because if you help them in one regard, then that might give them ammunition or reason to be able to chase preference claims. So there's always that hesitancy. Another reason why we're looking for the preference claim to be struck out, because then we can help insolvency professionals identify insolvent trading or creditor defeating dispositions where there's been Phoenix activity, those sorts of things. Yeah.
And what about, are your members seeing any increase in the incidence of fraud at all? I know it's a bit left field, but I'm just curious hearing you talk about that.
Yeah, probably the big one that people are looking at now is the invoice manipulation, where an invoice will be sent out as a PDF, and that gets intercepted, bank account details get changed, and then payments made. And then it's not till further months down the track when it's traced that it's found out that it was paid erroneously. And that leads to a very tricky conversation that you can understand the customer, but it's not the credit provider's fault. And there's been some recent court cases on that factor. So that's something that credit managers are aware of, and a reason why we're trying to encourage people to look at e-invoicing at the moment, because that's a new standard that allows invoices to be sent through the PEPOL initiative, which ensures there's great security there to prevent those sorts of manipulations.
I'll just say we're sort of just very, very shortly going to wrap up. So if you've got any questions, fire them in now. Okay. Well, that is interesting. I mean, yeah, we all get those weird emails, and that scenario that you talk about, I mean, that's quite frightening. I mean, the thing is to try and, obviously, someone changes bank details is to triangulate that, to make sure that
to make that phone call to verify that the details are correct.
Exactly. Pick up the phone. It's the best thing. 2 or 3 different data points just to make sure. Okay. Well, just as we wrap up, you guys get together regularly. You have face-to-face events with your membership on a regular basis. You know, what are the things that are most concerning them going forward for the rest of 2023? What's the most talked about thing at the bar?
What's going to happen? It's that uncertainty, where we're going. Obviously, making the most of your workforce at the moment's a big challenge. Making sure we can keep the right staff and work through that. So, yeah, trying to really get an understanding of where things are going as we're moving forward is the big pressure. Staying on top of the fundamentals.
Yeah. Well, Nick Pilavidis, I've got to say that you set the gold standard for member organisation CEOs. You are just so across every issue.
Oh, thank you.
Yeah, you obviously spend a lot of time with your membership, getting deep involved into what their concerns are, and it's amazing, you know, what the trends are and the things that impact it. There's really a lot to it, and the depth that you go into. So, thank you. It's been a real privilege to have you talk about these things. Thank you very much.
My pleasure. And if anyone's interested in that risk report, happy if you share that, Nick, or you can find it on our website. It's not restricted to members. It's something that, yeah, we want to inform the whole industry. So please do have a look.
Right, we will put a link. We've got your website link. We'll put that website link up when we in the socials when we circulate this. So if you're watching this, not now, but on playback, then have a look down and you'll see a link to this report. Thank you very much, Nick. Great to have you. Cheers.
Pleasure. Thank you.
Cheers. Okay, and thanks to everybody for watching. We will talk to you again very soon. Cheers.